In the last video, we learned how to compare ETFs by looking at the index they track, their expense ratio, diversification, and other characteristics. But today I'd like to ask a different question. What job is each ETF actually supposed to perform? Many investors end up buying ETFs simply because they've heard about them on YouTube or social media. Technology ETFs, dividend ETFs, artificial intelligence ETFs, small-cap ETFs, REITs. But investing isn't about collecting popular ETFs. Every investment should have a purpose. Today we'll learn the different roles ETFs can play inside a portfolio, and by the end of this video, you'll understand why some ETFs belong in your core portfolio while others are better suited for a much smaller, explore portfolio. Imagine you're building a research team. You wouldn't hire 10 people with exactly the same expertise. Instead, you'd bring together specialists with different strengths. Some generate new ideas, some analyze data, some coordinate projects, some ensure everything runs smoothly. A portfolio works in much the same way. Each investment should contribute something different. Some provide long-term growth, others reduce risk, some generate income, others provide exposure to specific industries or regions of the world. The question is never, is this a good ETF? The better question is, what job does this ETF perform in my portfolio? The first job is the most important, building the foundation. Broad market ETFs are designed to own hundreds or even thousands of companies with a single investment. Examples include VTI, Vanguard, Total Stock Market, ETF, ITOT, iShares, Core S&P Total, US Stock Market, ETF, SCHB, Schwab US, Broad Market, ETF. Rather than trying to predict which individual company will become the next success stories, these funds simply invest across the market. As companies grow or decline, the index adjusts automatically. This forms the foundation upon which the rest of the portfolio is built. The second job is international diversification. Many investors naturally invest mostly in companies from the country where they live. Researchers call this home country bias. However, innovation and economic growth happen all over the world. Europe, Japan, Australia, Canada, South Korea, India, Brazil. Many international ETFs provide exposure to developed economies, while others focus specifically on emerging markets. Examples include VXUS, Vanguard Total International Stock ETF, VEA, Vanguard FTSE, Developed Markets, ETF, VWO, Vanguard FTSE, Emerging Markets, ETF. Many members of the academic community come from emerging economies or maintain close ties with their home countries. Including international investments can broaden your exposure beyond a single economy, while allowing participation in growth occurring across different regions of the world. Evidence Corner. Research has consistently shown that investors tend to overweight companies from their own country, a phenomenon known as home country bias. While investing in familiar markets feels comfortable, concentrating too heavily in one country increases dependence on that country's economic performance. International diversification can reduce this concentration risk by spreading investments across multiple economies. The third job is stability. Stocks have historically delivered strong long-term returns, but they also experience periods of significant decline. Bond ETFs help reduce the impact of these fluctuations. Examples include BND, Vanguard, Total Bond Market ETF, AGG iShares Core US Aggregate Bond ETF. As retirement approaches, or whenever preserving capital becomes more important, many investors gradually increase the proportion of bonds in their portfolio. Remember, the purpose of bonds isn't necessarily to maximize returns. It's to help you stay invested during difficult markets. Once a solid foundation is in place, some investors decide to tilt their portfolio towards specific characteristics. Examples include growth ETFs. Example, VUG. These emphasize companies expected to grow earnings rapidly. Value ETFs. Example, VTV. These focus on companies that appear undervalued relative to their fundamentals. Dividend ETFs. Examples: SCHD, VYM. These emphasize companies with a history of paying dividends. Many investors approaching retirement use dividend-focused ETFs to generate income. Others include them earlier in life because they appreciate their potential for lower volatility and more stable cash flows. Small-cap ETFs. Examples: VBIJR. These provide exposure to smaller companies that may offer different growth opportunities, although they generally experience greater volatility. These ETFs don't replace the core portfolio. They simply change the emphasis. Finally, we arrive at the Explore portfolio. This is where many investors express their personal interests or convictions. Examples include thematic ETFs focused on technology, XLK or VGT, semiconductors, SMH, artificial intelligence, BOTZ, cybersecurity, CIBR, healthcare, XLV, real estate, VNQ, and robotics, ROBO. Here you can also add individual shares of companies you deeply understand and wish to follow closely. These ETFs are much more concentrated than broad market funds. That means they can experience both larger gains and larger losses. This is why many long-term investors choose to keep these investments to a relatively small portion of their overall portfolio, perhaps around 10%. An important point is that your core portfolio already owns many of these innovative companies. If you own a broad US market ETF, you already own companies such as Microsoft, Nvidia, Apple, Amazon, and many others. The Explore portfolio doesn't necessarily introduce completely new companies. Instead, it increases your exposure to a particular sector or investment theme because you believe it may play a larger role in the future. Think of it as increasing the volume of one section of an orchestra rather than adding entirely new instruments. Let's bring everything together. A well-designed portfolio often consists of 3 layers. The core portfolio, broad US market, international markets, and bonds. These provide the foundation. Portfolio tilts, growth, value, dividend, and small cap. These adjust the characteristics of the portfolio without replacing its foundation. Explore portfolio, technology, artificial intelligence, robotics, healthcare, real estate, other specialized sectors, and individual companies. These allow you to express specific investment ideas while limiting the impact that any single theme can have on your long-term financial future. Conclusion and assignment. When people first begin investing, they often ask, which ETF should I buy? But experienced investors ask a different question. What role will this ETF play in my portfolio? Once every investment has a clear purpose, building a portfolio becomes much simpler. Your assignment before the next video. Look at your current investments, or the portfolio you're planning to build, and classify each ETF into one of these categories: core foundation, portfolio tilt, and explore portfolio. Ask yourself, does every ETF have a clearly defined job? If the answer is yes, you're already thinking more like a portfolio manager than someone simply buying investments because they're popular. Remember, build the foundation first. Add purposeful tilts. Second, explore carefully, and only after the foundation is solid. Thank you for watching, and I'll see you in the next video.